Bruce Weber is Professor of Information Management at London Business School. Pleased to say joins me in the studio now. Bruce, thank you so much for coming in. First of all, just want to ask you about LSE's results. At first glance, what's the big takeaway for you?
Well, there's a bit of growth, but it's very moderate. I don't think investors are getting too excited about the kind of growth numbers they're showing. The cash equities business, which they're very reliant on, is very flat right now. And that's not just a London situation. You see that in the US and Asia, too. The growth is in derivatives right now.
Okay, and that puts LSE at a significant disadvantage compared to many of its competitors?
True. They don't have a very big derivatives operation.
And how does it compare to, say, the likes of a Chicago Mercantile exchange? I mean, when you look at, is that like a more comparable exchange to the LSE? And they've enjoyed some decent growth, haven't they?
True. I think any exchange CEO would be quite impressed by what the Chicago Mercantile Exchange has done the last 3 or 4 years. They've gotten a few mergers to work out very well. Chicago Board of Trade and IMEX, they're the dominant player in the derivatives industry, and they're showing growth that's impressive to investors.
So what are they doing that others perhaps aren't?
Well, I think what they've shown is you can build a single trading platform and put more and more product on it. And I think the derivatives industry overall has been very innovative in new product development and coming up with different kinds of offerings for investors. I don't think the equities markets have really kept up with that.
Is that likely to change anytime soon?
I'd like to think so. I'd like to see listings go up. If I were at a cash equities exchange, I'd really want to see more companies coming through the pipeline. I'd like to see more LinkedIn type IPOs coming out, but we don't see as many IPOs as we saw 5-10 years ago when these exchanges were becoming publicly listed for the first time.
And a lot of companies pulling their IPOs because of tough market conditions. Do you see that likely to change anytime soon, this year or next year?
I think you'd really need to see some more stability in the global economy to entice a company to say now is the time to do our IPO. I think they're going to hold back. Private equity and venture capital can provide a lot of funding in the interim, but you'd really like to see these companies becoming publicly listed, and they haven't been coming.
Okay, so what does the LSE need to do then in terms of strategy in the aftermath of its failed bid for TMX, and particularly when you take into consideration the nature of its business, because it is only an equity exchange, isn't it? So does that put it at a strategic weakness automatically?
They have a small derivatives activity, but not too substantial. What they need to do really is come up with a strategy. It's a bit glib to say that, but their strategy up till now, I think, has been M&A. Let's find a good way to win in this consolidation game, and I think they thought the Toronto combination, which would have given the LSE about 55% of the combined entity, was a good deal. It didn't go through, and they've got to be very envious of what New York Stock Exchange and Deutsche Börse did, getting both sides of the Atlantic to agree on a massive merger. They couldn't even get it to work with a $4 billion combination. So it's a bit of a slap in the face to Xavier, but I suspect he'll bounce back.
So, but then does this make the LSE vulnerable as an acquisition target?
It does. It does. They're not a particularly expensive exchange now. I see their PE is about 13 or 14. So if you're NASDAQ, if you're Singapore Exchange, if you're Tokyo, you might think here's a really good asset. But I think what we've learned about exchange consolidation is it's different than standard M&A activity. You've got to have support of the national government. You've got to have support of the end users of the exchange. You've got to have management support. Hostile takeovers don't work in this space.
So these guys can't rely just on M&A for growth. They've got to come up with other ways of
I think they've got to
growing business.
Figure out how they can get their own business growing to make themselves, an attractive target, and also to get a good valuation from any takeover bidder for them. I think they can do that, but I think there does need to be probably a clearer strategy and maybe a stronger push into the derivatives space and other areas where they're going to see some growth greater than what they're getting out of cash equities right now.
Maybe we'll see that happen this year. And if we do, you should come in and talk about it.
I'd
really
like to
good
see
to have
that.
you. Thanks very much, Bruce Weber, Professor of Information Management, London Business School. Great to get your analysis.